topic today is managing your financial health during COVID and beyond. On 4th of July, we had an excellent talk by Dr. Sudha Seshayan, Vice Chancellor of Madras Medical University. And she said the definition of health is state of well-being, physically, mentally, socially, and spiritually. So she put 4 phases to the health. Obviously, there's not much social thing going on now. So now Ajay is going to add another phase to the health, which is finance. If you have a good finance, you are happy and you will have a healthy life. If you haven't got a good finance, you are not happy, and that will affect your health. Now, this is what Ajay is going to bring out to us. As a sort of introduction, Ajay is a highly qualified and reputed independent financial advisor. He and his dad is also on the screen. They work for a company called Fairston Financial Management, the UK's largest chartered financial planning firm, 40 branches across UK, and managing 12 billion of clients found. He was recently featured in Times and Telegraph as one of the UK's highest rated independent financial advisor. He's going to cover, I'm sure I don't want to steal your topic, but I want to tell our members so that they expect what to expect from you. Managing your savings. Recent NHS pension changes, which I don't know much, and I'm sure some of the members may not know about it. Reducing tax. Reducing tax, if you can highlight the inheritance tax planning, that will be nice, because most of the members in the group, we are sorting out our last time will and inheritance tax planning. And also he's going to talk about current investment and market opportunities. Right, over to you, Ajay.
Hi, good morning, everybody. Thank you very much for giving up your mornings to hear me. Hopefully, you'll leave more enlightened and happy that you attended today. Thank you, Raju, and to MSMA for giving us this opportunity to talk to you all. I know we were hoping to have a wonderful conference in Leicester not so long ago, which of course due to COVID we couldn't do. But as I understand it, that is now, we're hoping to do that next summer. Is that right, Raju?
Yeah.
And so hopefully we'll get to see a lot of you and meet you face to face when we welcome you to Leicester, my hometown, and of course home of the best football club in the UK at least. But that's for another day. So I'm just going to Raju, you okay for me to share my screen and start my PowerPoint?
I think I leave that to Elil, the expert.
Yeah, okay. So I've just started the slideshow. Hopefully this should have started for you now.
Yes, we can see.
Can you see the slideshow? Has the slideshow started, or is it still in PowerPoint?
I can't see the PowerPoint.
Just bear with me a second.
Yeah.
Right. So can you guys, can someone just tell me whether they can see the PowerPoint?
We can't, no.
Not yet.
Okay.
Oh, yes.
Right.
Yeah, we can see that now.
Okay. Bear with me. Sorry, I'm having a technical issue on my side. Please bear with me.
Okay.
Right, okay. So you should be able to see a photo of me now. Can everyone see that?
Yes.
Yes.
Yeah, okay. So everybody, just to introduce myself, Ajay Naik. I'm a medical specialist independent financial advisor. So just like my father, Naren, who is also on the group today, we specialize in working with doctors spend the vast majority of our time working with doctors and also other high-earning professionals and business owners. You've got my contact details there as well. Anyone who wants to contact me separately outside of this meeting to discuss anything on a confidential basis, then by all means, email me, phone me, WhatsApp me, whatever is easiest, and we'll help you in any way we can. So very quickly, as Raju already mentioned, we are part of a group called Fairstone. Fairstone is the UK's largest independent financial planning firm, with the dual qualification of being also the UK's largest chartered financial planning firm. Now, chartered financial planning really does represent the gold standard of financial planning in the UK. So you can be assured that you are talking to people today at the very, very highest standard that you can get. And I think just to make it clear, in case anyone is wondering, well, what the hell does independent financial advice mean? When there's so many different kinds of financial advice in the UK, you will have come across other large firms, especially as doctors. You will have come across firms like Wesleyan or St. James's Place. The main distinction between us at Fairstone and other larger providers is that keyword independent, which effectively means that we are not tied at all, and all of the advice that we give is completely centric to each client's individual personal circumstances. So we have the complete freedom to offer and advise on anything that we want, and we're not restricted to a limited panel of products, which effectively ultimately means that we're able to do things normally on a more cost-effective basis, and we tend to outperform in all benchmarks. The good thing about Fairstone as well is that completely whole of market. We also have a very large, as Raju said, we look after over 12 billion pounds of people's money. So we have a very large investment infrastructure in-house as well, including discretionary fund management. We also arrange around £2 billion of property finance a year. So we're very comfortable about having conversations around property and property investment. And as Raju already mentioned, inheritance tax is quite a big topic for everyone. And so estate planning does fall within that. And I'll talk a bit more about that today. Just also very quickly, just to mention that Fairstone is also the #1 rated wealth management house on Trustpilot. So even if you just Google Ajay Naik Fairstone, you will find me on Trustpilot, on Vouched For, and various other sites where you'll be able to see all the lovely positive recommendations and testimonials that my clients leave for me and other Fairstone advisors. So what are we going to talk about today? I'm aware that it's quite a mixed audience in terms of your specialties. I'm going to just give you a very quick update for those people who are more on the business side. What's going on in the COVID business support packages at the moment. I'll just very quickly touch on any insurance related issues around that, and what kind of support you could possibly get from your existing insurance policies. I'll then move on to various tax legislation changes with regards to NHS pensions, some key updates that took place in the last budget, and then we'll move on to what's going on in the global economy, the investment markets, and where do we see the opportunities, and what are we doing for our clients and their funds at the moment. So just a quick overview of the COVID support packages. As you know, there's a lot of packages there, as you can see on the left-hand side. I'm not going to go into all of these in great detail just because time restraints today. By all means, I can answer any questions at the end, but I'm sure you've probably come across a lot of these already, such as the furlough scheme, the bounce back loans, and various other things. So I just wanted to give you a quick update on where we are with these, as a lot of these are sort of coming towards the end point and we are moving towards the recovery phase. So first of all, any of you who are, for example, GPs, or you're employing any members of staff, you can still get a refund if any of those employees are having to self-isolate and claim statutory sick pay. So the key difference is, though, is what the government has now said is, of course, we have lots of quarantine rules coming in. So, for example, we know now that even Portugal, anyone coming back from Portugal is now going to have to quarantine. So just because a member of staff or an employee of yours says to you, well, I've had to quarantine, that doesn't give them the right to claim statutory sick pay. They have to be able to demonstrate that they've got some symptoms or having to shield because they're living with someone who has symptoms. So in that circumstance, they are eligible to get statutory sick pay. And so you as the employer can then claim the cost of 2 weeks of that sick pay back from the government, and you can do so through the PAYE online HMRC portal. The furlough scheme, again, this is if you are employing anyone at the moment, then the furlough scheme does close on the 31st of October. So that's just worth bearing in mind. So as it stands right now, up to July, you can see in the table here, up to July, you can still claim, and August, you can claim 80% of any employee's wages under the furlough scheme. However, you'll notice that from September and October, and the scheme does close in October, the amount that the government is willing to refund you is reducing. So you can see it drops down to 70% and then 60%. Can you guys see my mouse moving around on the screen? Yeah.
Yeah.
Okay. So yeah, that's something to be aware of, as well as any pension contributions that you're making on behalf of the employees as the employer, and also national insurance contributions. You will now have to pick up the tab for those as well. So the government was paying for those. Now you're going to have to pay for them as well. Okay. The key thing is that if you haven't actually made any claims for any furloughed staff, then unfortunately you are too late now. You have to have made your first claim by the 31st of March, 31st of July. And if you haven't, then unfortunately it's too late. The other thing to worth bearing in mind is if you are employing anyone at the moment, then as long as you have brought them back from furlough and they are still on payroll as of the 31st of January, you will get £1,000 grant from the government. And again, that will be done through the furlough PAYE system. Again, any specific questions on that, I can answer that later. Just for you to also bear in mind, if you are self-employed or employed, there is still the HMRC time to pay scheme live. So you'd have to phone HMRC, but from a tax planning perspective, or sorry, a cash flow planning perspective, you do have a lot more time to make your payments. So even if you had your self-assessment on account payment that was due in July, you do have time to make that payment, and you can delay it if you want to, but you do need to tell HMRC that you're doing that. So you do need to phone them. Obviously, just be aware that there are very long wait times to get hold of HMRC. They do have an online chat function as well, and I've heard mixed reviews about how that works. Similarly, if you have a limited company, so for example, you've got private practice and you're running a limited company, then you do have an extension on filing your annual returns as well. So you can delay that by 3 months, and that obviously can just help you with a little bit of potential tax planning and cash flow planning as well. There was an automatic VAT deferral scheme in place that has now come to an end. So just bear in mind, if you are VAT registered, some of you may be, some of you may not be, depending on the nature of your private practice. Then you do have to now make sure that you are paying those that deferred VAT bill back. You have until the end of this current tax year to make that VAT payment due. Obviously, that was only a delay for VAT payments due up to June. So as of July onwards, your VAT payments are now due. So you have to carry on doing your VAT payments and your VAT returns as standard. The business interruption loan scheme, I'm just going to skip past this now because effectively it's closed, and I don't think any of you would have accessed it. But if you haven't and you're thinking about it, then it's now only really available for more larger businesses. It's not really available for small businesses now. The bounce back loan scheme, which is the other one that you will have probably heard of, which any business, whether you're self-employed or employed, you could take this up. It's now ends on the 4th of November. So you still have a very limited window if you are interested in getting that up to £50,000 loan from the government, which is interest-free, or the interest is covered for the first year, no repayments due for the first 12 months. You can still get that done through your bank. If you are self-employed but effectively you've got your own personal service company. So, for example, you're a consultant and you've got your own limited company, and maybe you also have your partner on that business because he or she may be a shareholder, and you may be paying them dividends and trying to tax efficiently extract income out of the business. Then just bear in mind that there are still opportunities if they are on furlough and your partner is on furlough. Then you can still carry on doing so until October, and all the other schemes are obviously still in play as well, and eligible for you guys as well if you fall into that category. If you're a sole trader, then I'm afraid nothing new has been announced really for sole traders. There was the self-employed income support scheme that was launched. That's still live. So rather than you getting the furlough scheme, the equivalent of the furlough scheme for self-employed people is this scheme here, where you can get up to 80% of your trading profits, and it's an average over the last 3 years or 2 years if you only have 2 years income trading. So again, if you want any specific detail on that and you want any help with accessing that, then let me know. And otherwise, the only other support available for sole traders is the Universal Credit and Employment Support Allowance, which, to be frank, is pointless for people in your situation. The final point I'll make on COVID at the moment in terms of getting support is just bear in mind that, and as Raju pointed out, that health is such an important thing, and it's something that, you know, as advisors, we're very, very keen on talking to with our clients, in the sense that it's not just about your money, it's about your mental state of health, it's about your physical state of health. Happiness at all times is derived from all of these areas, and not just you, but also your families. So if you have any insurance policies already in place, for example, income protection plans, critical illness policies, quite often these plans, especially from the better providers, will have various added value benefits built into them. So a lot of them these days do have free counseling services, free remote GP services, and other health, dietary and nutritional advice services, which are completely free, and you should take advantage of those services. Obviously not teaching you to suck eggs, as you guys are doctors, but you know, these services are free, and you know, a lot of our other healthcare clients are taking advantage of them. So just bear in mind, it's worthwhile just checking your policies to see whether you have any of those services attached to them. Again, if you want any help in identifying whether your policies do, then just let us know. Tell us what your policy is and which provider you have it with, and we'll be able to tell you. If you have been off sick and you have income protection, then again, just worthwhile looking at the deferred period. How long do you have to be off sick before you can claim? And likewise, any family members, because again, you may be able to claim on that. Likewise, if you're running your own business or private practice, if you've got commercial insurance in place, then there may be business interruption insurance. So if you haven't looked at that so far and think you may be eligible for a claim, again, it really depends on the definitions of within those individual policies. And again, we can help you with identifying whether claims are going to be possible or not. So I'm gonna move on. I'm just gonna quickly look at. Have there been any questions raised in the chat function so far, Azil?
Just one question. We have Dr. Chandana. She's asked, does SSP apply for self-employed, i.e. a dentist?
Sorry, could we repeat that?
Does the statutory sick pay, SSP, apply for self-employed dentist?
No, you're not entitled to statutory sick pay as a self-employed individual. So if you are self-employed, then just quickly going back to this slide here, then that's the scheme that you want to claim on if you've not been able to trade, or your trading has been disrupted. Then it's the self-employed income support scheme. Yeah, this is specifically, it's a grant that you can apply to based on an 80% of your previous average of your previous year's trading profits. Yeah, so for example, the maximum that they will look at is 50,000 average. So even if your trading profits, your net profit over the last 2 or 3 tax years has been more than 50,000, they will cap the 80% to 80% of the 50,000, and that's a grant that you'll get based on that.
There's a comment from Jawahar about council grant.
Okay, so the small business rate relief grant.
Yeah.
Yeah. Okay, so that is something that your local authority will be doing. As far as I'm aware, those schemes are still open, so you'd need to go directly to your local authority. The only way that that you can qualify for that particular grant, which is up to £10,000, is if your premises, your trading premises, already qualifies for small business rates relief.
Right. Thank you.
Now, as it happens, local authorities have been also forwarded or have been given from central government very large additional business interruption funds. So each local authority will have its own support fund, which is discretionary, where you effectively apply to them and you ask them for some money to compensate for the fact that your business is now trying to get back on its feet. Now, the best way of looking for those is through your local enterprise partnership. So, for example, the one in Leicester is called the Leicestershire local enterprise partnerships, so LLEP. But if, for example, you're in the north or wherever you are, there will be a local enterprise partnership. So just Google LEP and it will come up with your local LEP. And then there will be a contact, there'll be contact details, or go to their website, and then you should be able to see on there a summary of all the local funding schemes that have been launched as part of COVID. Does that make sense?
Thank you.
Can I just ask you, Ajay, can your firm can help people to signpost them? I heard about these grants. Not one or two people in our East Midland Caris got it, but nobody seems to have signpost exactly what we should be doing. Maybe I'll have a private conversation with you later.
Yeah, I think it'd be best if we can arrange private conversations.
Right, thank you.
Yeah. Okay, brilliant. Okay, I'm conscious of time, so I'm going to move on. So, favorite topic of the day for everyone on a Saturday afternoon. And I don't know about you, but just as I clicked on this slide, the sun has gone in behind the clouds where I am in Leicestershire at the moment.
Oh.
So NHS pensions, always a hot topic for doctors. I have to say personally, I'm a big advocate of the or a big supporter when it comes to how badly the government handles this particular issue. And I do feel very sorry for you in the way that you guys get penalised when it comes to the pension. It just seems like it seems quite unfair to me. But the big issue really was the tapered annual allowance for a lot of doctors. So this is where a lot of doctors were thinking, oh my God, I've earned over £100,000 this year. You only find out, of course, in retrospect, in the next tax year, that you lost some of your annual allowance as a consequence of that. So let me just quickly rewind there to say, well, what is the annual allowance? So the annual allowance is effectively how much am I allowed to make in terms of pension contributions in any one tax year. So the current annual allowance is £40,000. So and that allowance effectively is the capitalized value of the increase in your NHS pension in your NHS pension benefits. So what is your entitlement from last year compared to your entitlement to this year? So for example, if your NHS pension was worth say 20,000 last year and this year it's gone up to 25,000 at your stated retirement age, then that extra increase of say £5,000, we have to apply a formula to capitalize the value of that. And if that is, and then add that to any personal pension contributions you have made. And if all of that exceeds £40,000, then you have a tax bill to pay. But the problem is then with the tapered annual allowance is that if you earn above a certain amount, then that 40,000 allowance can then be reduced. And that is where a lot of doctors have been stung. Now, in my experience, a lot of doctors that I work with were not aware of the fact until I told them that actually in the last tax year, the government put a moratorium on the annual allowance tax bills, the tapered annual allowance tax bills for the previous tax year, because of a lot of the issues that we're facing in the crisis that we had in the NHS last winter. So they basically came out and said, look, any doctor, we don't want you to not take on extra hours on the fear of having an annual allowance problem. So they promised that they would pay for any annual allowance tax bills in the previous tax year. How they're going to do that, we still don't know. But obviously that ended in the last tax year. So in this current tax year, 2021, from April, we're back to the normal rules. But the good news is that they have at least increased the thresholds for the tapered annual allowance. So just coming onto that in a bit more detail. So you see there in terms of the annual allowance, which is £40,000, or whatever your tapered annual allowance is, if it's lower, then anything above that, you will pay tax on your highest marginal rate, depending on whether you're a 40 or a 45% taxpayer. You can get the NHS pension scheme to pay for any tax bill directly. So it's called the scheme pay system. There are deadlines in terms of telling the NHS if you want them to pay for any tax bill. But of course, it does end up working out more expensive because effectively you're taking out a high interest loan. That's the net effect of it. So it does reduce your pension benefits quite, more than it should do. Now, the tapered annual allowance, I'm not going to go through this in huge depth because it will put you to sleep. But basically, the threshold, the starting threshold, the test to see whether your annual allowance was tapered down, started out with total taxable income of £110,000. So basically, if you take your total taxable income, and from there take away your NHS pension contributions, employee pension contributions. So if you're all at consultant level, then you're looking at 14.5% of your pensionable earnings. So 14.5% of your pensionable earnings. Take that away from your total taxable income, which, by the way, includes dividends, any other clinical excellence awards, whatever they may be. All of your income. Take away any individual pension contributions. If that level was above 110,000, then you moved on to step 2. However, that threshold income stage, that first step of the test, has now increased to 200,000. So that, by its nature now, precludes far more people. So unless you are a significantly high earner, then you should be okay. So in my experience, about 70 to 80% of doctors are no longer affected by this threshold income issue. And so we should be okay. And what we can do, perversely, is we can use private pension contributions, assuming you have a certain amount of annual allowance left. So it's a very complex calculation, but we can, in fact, reduce your threshold income below that level by making further pension contributions. It's quite an interesting sort of quirk in the system, but HMRC is aware of that. Now, do bear in mind, by the way, that just because the threshold income has increased to 200,000, that doesn't mean that you are automatically escaped from the annual allowance issue, because the annual allowance is still £40,000. So if you are in the 95 section of the pension scheme and you've had well over 25 years of service in the 95 section, then there is still a good chance that you are bordering on that £40,000 annual allowance threshold. So this is where you need really good sound advice. The problem we have is that the NHS pension savings statement that you get is always at least a year behind. So how can you as an individual forward project whether you are likely to have an annual allowance problem in the year ahead? It's very difficult to do so. But of course, that's where we step in and we can help you with that process. So if in doubt, get professional advice. The other big issue is the lifetime allowance. The lifetime allowance is effectively the total value of your pension savings that you can have. So, oops, sorry, accidentally went a bit too far. So it was originally 1.8 million, and then bit by bit it has come down. So the way that we look at the lifetime allowances, with any personal pensions you have, private pensions, it's literally just the fund value, whatever the cash value is of that pension. But with your NHS pension, we have to again run a formula to capitalize the value of your pension. So for example, the quick way of looking at it is to say, okay, well, what is my projected income at the age of 60 or 65 or whatever, times that by 25, and then that is the capitalized value for lifetime allowance purposes. The current lifetime allowance is 1.073 million. So it went down to 1 million in 16-17, and then bit by bit it has been increasing in line with inflation or CPI. Obviously, in this last 12 months, CPI has been virtually zero, so it's unlikely that it will increase considerably more from that 1.073 million in the next tax year. But if you are getting close to that borderline, then there is different kind of protection you can get in place. So for example, the best one we can look at is individual protection 2016. So this is where if your value of your pensions was over £1 million at the 5th of April 2016, then we can then protect you for the higher level up to a maximum of 1.25 million. So again, complicated stuff, and get professional advice, and then we can guide you in terms of what's the best thing to do for you. The other quirk with the NHS pension is around this thing of early retirement. And this is why I say mind the gap, because you may be aware that, of course, all of you are now in the, if you're still working, you're now in the 2015 section of the pension scheme. So you were originally in the 95 section of the pension scheme, which was a proper final salary pension. The retirement age of the scheme was 60. Then, of course, they brought out the 2008 section, and the retirement age moved to 65. And now the 2015 section, the retirement age is your state pension age. So it's no longer a fixed age, it's the state pension age. So that could be, depending on your age, 66, 67, 68. In my case, I'm just bordering on 40. My state pension age is 68. I think by the time I get there, it will probably be 80. Who knows? That's the government for you. But this is where, again, it's very, very tricky to plan for, because when you get to 60, if you've got 95 section benefits, that's fine. You can take them at the age of 60, no penalty. But if you've got, say, another 10, 15 plus years to go, and you've got your NHS, you've got quite a lot of pension in the 2015 section, if you now try and take those at 60 along with your 95 section, then you will be heavily penalized. So for example, if your retirement age is 68 for the state pension age on the 2015 section, and you want to take your benefits at 60, then that's a 40% penalty on your 2015 section benefits. Effectively 5% penalty for every year you want to retire early. So the key with this is how to manage what you want to do in terms of retirement, and getting you to the point that you need to in terms of your retirement savings pots. And so this is where we would do a lot of work around bridging the gap, and trying to find ways of saying, okay, well, if we want to minimize the penalty you're going to pay on your pension because you don't want to be retired at the age of 67, 68. And I think this is where, again, I say it's a real perversity, this whole idea of early retirement, because as doctors, you slog your guts out, you work very hard. And I find it very rare that I find a doctor who isn't kind of feeling burnt out and tired by the time you get to 60, 65, so forth. So having, the government now forcing you to work so many more years when, quite frankly, you sacrificed so much to keep people healthy and save lives, I think is atrocious. But there are planning tools that we can use. So again, depending on annual allowance, lifetime allowance, we can use personal pension contributions. We kind of do of course use other kinds of investment as well. The good thing with personal pensions is they are far more flexible than the NHS pension. So currently, you can take private pensions from the age of 55. That, by the way, that rule is now increasing to 57. So in a few years from now, the freedoms age from when you can take benefits from personal pensions will be 57. But ultimately, that's the only stipulation. So the good thing with personal pensions is we can actually use it as an effective way of tax planning your tapered annual allowance. You do get an amazing amount of tax relief as well. So effectively, your contributions are rolled up and gross rolled up quite considerably. For example, for every £1,000 that you want to put into a pension, only £800 actually comes out of your pocket. The government puts in the other 200. And then if you're a 40% taxpayer or a 45% taxpayer, then you get another 20 or 25% tax relief on top of that. It also allows you to regain your personal allowance. So if you're earning over £100,000, the amount of income between 100 and 125,000 is taxed at 60%, because you lose your personal allowance for every £2 you are above £100,000. So the effective rate of tax between 100,000 and 125,000 is 60%. So by making personal pension contributions, you can actually regain that personal allowance because of the way that the income tax calculations work. The other good thing about pensions is that they are very, very flexible. You can invest into pretty much whatever you want these days, even commercial property. So if you have a practice, for example, a GP practice or a dentist, dental practice, whatever, then you can use your pension to purchase and to run that commercial property. And it's also inheritance tax friendly as well. So some very good benefits of using personal pensions, assuming that the annual allowance issues play within our favour. Other than pensions, how else can we save money in a tax efficient manner? Well, of course, we all have ISA allowances. So we have £20,000 a year each. If you have children, then there are children's ISA allowances as well, junior ISAs and so forth. So there are lots of ISA allowances. If you have children who are planning on buying their first property at some stage in the future, then there is also the lifetime ISA. which is similar to the Help to Buy ISA, but better. And then once we've used up your pensions and your ISA allowances, then there are other forms of investments that we can use. So, for example, general investment accounts and so forth, investment bonds. So there are various different kinds of tax wrapper that we can use depending on which tax allowance we want to take advantage of. Because as individual taxpayers, you have lots of different tax allowances, not just income tax, but we have capital gains tax and various others as well that we can take advantage of. As high rate taxpayers, the other thing that's worth bearing in mind is something called the Enterprise Investment Scheme, or EIS. Now, the Enterprise Investment Scheme is by its nature high risk, but it is very, very beneficial from a tax planning perspective, and the second best thing to pensions when it comes to tax planning. So the good thing with an EIS scheme is that you get an immediate 30% income tax relief payment. So what that means is, for example, if you're investing using round numbers, £100,000, once you put that investment in, you'll get £30,000 back from the government within 6 weeks normally of making the investment. That investment is going to be inheritance tax free after 2 years, and it also allows you to make CGT deferrals as well. So for example, if you just sold a property and you've had a capital gains tax due on that property, even if it was in the previous tax year, because you can carry back, then you can then invest that money into an EIS scheme, and that will then defer that CGT bill to another point in the future. You can then also use that as a way of tax planning your income tax. You can also do loss. You can then take advantage of loss relief if you want to create losses within certain tax years and so forth. So there are some very, very clever tax planning tools that are available to us. And again, we can usually manage within risk parameters and also take advantage of different kinds of investment in terms of sector and disciplines and so forth. So let's now we moved on to the topic of actually investment. What's going on in the investment markets at the moment, and should we really, how should we feel about everything? This slide, apologies, it's a little bit pixelated, but what this is really demonstrating is well, what kind of bear market have we just witnessed, and what kind of crash and correction have we seen? And this was a chart that was put together by Goldman Sachs, and what it basically demonstrates is over history, you get different kinds of market crash. So you get what's called structural, cyclical, or event-driven. And the point this slide is making is that if you look at, say, the very last one that we had prior to COVID was the global financial crisis in 2007, the credit crunch. That was what we call a structural issue. So that was where there was a fundamental underlying issue in the global markets. There was a structural problem, hence the term credit crunch. And that's where you can see the drop was a very considerable drop. The length of time that the drop took place was quite long, 120 months. And then on top of that, the time it took to recover, equally similar. What we've just seen is an event-driven issue. So, this was specifically a very specific event that caused this ripple effect around the world. And you can see there that the average decline and the length it takes to recover is much, much smaller. Now, I originally put this slide into my presentation back in February when we were first talking about COVID. And what we've now seen is exactly this has transpired. So the length of recovery, if you look at how markets have now bounced back, it's exactly as this is said. In fact, it's taken a lot quicker to recover than what we would expect. So if you look at this slide here, you can see the green line is the FTSE World Index. So basically, this is looking at a conglomerate or aggregated index of all the global world indices, stock markets. And you can see that there, you can see back in March, there was the big drop. And this is as of literally 2 days ago, you can see where an aggregate of the global markets is. So you could then be saying, well, okay, have I missed the boat? Because frankly, clients of ours who were sat on cash and waiting to go into the markets at the right time, we invested money here at the bottom, and we're now sat on a 25% profit on average for our clients, where we invested at this point here. So that was lovely. And now you may be thinking, well, okay, have I missed it because markets have recovered? Well, the point is, no, you haven't. There's still a lot of growth and recovery still to come in the global markets and in the global economy. And one case in point is if you look at the FTSE 100. So you can see the FTSE 100, the blue line, has bounced back, but it's only halfway through its recovery. So, you know, if you just look at a global aggregated level, yes, but you obviously have to bear in mind that this is weighted depending on the size of markets. So the S&P 500, the Nasdaq, and so forth, the Chinese markets have had quite a significant return, and they've gone higher. But a lot more markets are still on the road to recovery, and we're only about 50% there. So it's really about taking a bit more of an analytical view, looking more microscopically to see, well, which are the markets, which are the ones which still have plenty of growth potential within them, but obviously taking into account, well, just because they have growth potential doesn't mean that they are the markets to go into, and you know, what kind of level of risk do those markets bring with them. But case in point is, as investors, we tend to always, and investment managers, we always tend to take the long-term view. You know, there are short-term plays we can make. So, for example, when we went into the markets in March and said, look, here you go, we're pretty much at the bottom, if not the bottom, let's go in because we're buying dirt cheap. You know, did we expect and did we know that the markets were going to recover in the space of 3 months, 6 months? Possibly, but, you know, we did manage people's expectations. It could take longer, but that was a short-term play. But what this slide shows you is that if you had invested money 30 years ago and just put £10,000 in 30 years ago, and regardless of what was going on in the markets, just literally stayed in, day out, and never took money away, you would right now be well above £115,000, right? And what it shows you is the effect of not being in the market based on missing the best 5 years, 5 days, 10 days, up to even 30 days. So the strength of long-term investing, when you're looking beyond 5 years, 10 years, that sort of level, is actually the cost of not just being in the markets, regardless of what the market timing is, can be very, very expensive. So clients of ours, where we put the money back in March, and we're now having those conversations, well, what do we do? Do we come out? Do we stay in? Whatever. Our view is, it's always good to take, with at least a proportion of your portfolio, a longer term view and just stay in, because the cost of not staying in can always be quite high. Looking beyond COVID now, it's quite strange, isn't it, to see, well, look at the buffoons that we have in our global market staying. Who are we reliant on when we put our lives in these people's hands? And I can say this as we are all Indians here. The only smart person in that collection is the lovely Rishi Sunak. And thank God we have an Indian who has some proper sense of control and an influence in what's going on in at least the UK economy. But in terms of joking aside, what's going on? Well, I'm very buoyant, and Fairstone as a whole, we're quite positive in terms of what's going on in the global markets and you know, and the potential. It's going to be very bumpy, and it's going to be very volatile over the next few months. But still, looking beyond that, it's a very positive time for global for risk assets such as equities. We've got unprecedented levels of intervention around the world. Quantitative easing is still going on at unprecedented levels. So, you know, governments are literally buying corporate bonds right now off the market, and they're plowing money into the economies. They are really starting to heat the economies up. What that really means is we've got very low interest rates. We've got high levels of inflation coming through, and that's effectively going to mean that over the next few years, cash returns are going to be, in real terms, worse than they ever have been. So if you look at real-term inflation rates, so looking at inflation, you know, which is going to go way beyond 2-3% in the next few years, especially if you look at the monetary policy in the USA that they've just announced, you know, we're going to see quite high inflation. Now, the only asset classes which are going to keep pace with that are going to be the riskier ones, such as equities, and it is going to be equities which are going to carry on rallying in the next few years. So, but just looking at very specific issues in the very short term, obviously we've got the USA issue. People, you may be aware, by the way, that we had the FANGs, so the big tech stocks in the US. They had a big correction in the last couple or 3 days. So your Apples, your Facebooks, your Amazons, you know, that we had a little drop there. That's just a short-term correction because there's short-term profit taking going on. But we're still confident that, you know, they are still good stocks to have as part of a portfolio. But we do have the geopolitical issues starting to rear their heads again. So we've got the issues with China. and the trade wars around that. Although the rhetoric seems to be quite positive on that at the moment. Obviously, we've got the US election, which we're watching very carefully. Joe Biden is talking about increasing corporation tax in the US, so that may have a knock-on effect. Obviously, in the UK, we've got Brexit coming back again, and the FTSE 100 that has stalled, and the reason it has is because it is very, very service-driven. Whereas you look at other major economies, they're not as biased towards the service economy. That said, the vast bulk of the UK market, if you look at the FTSE 100, the FTSE 250, they derive the vast bulk of their income from overseas. So that actually plays in our favour at the moment, with the UK actually being quite stronger in terms of pound levels. And then we've got China, of course. And I also put in this lovely man here from North Korea, because he's kind of disappeared recently. Kim Jong-un. He's not really been in the agenda recently, but I bet you in the next few months he'll start popping his head up again above the parapet, and we'll start seeing some stuff coming through from that part of Asia as well. So it'll be interesting to see what happens there. The key really is, as always, asset diversification, global diversification, and this is for me, the market right now is very much about really being clever and actively managing portfolios and taking advantage of opportunities as they come up, but equally managing risk and being aware of a lot of the issues in the short and medium term coming on the horizon. Opportunities going forward then, I don't want to sound like an eco warrior, but I do think climate change, whether you believe in it or not, is a really, really big turning point for the global economy in the next few years. Even Mark Carney at the recent climate change conference said we can't isolate from climate change. It is on the global agenda for all governments. Whether you believe in climate change or not, doesn't matter. The fact is there are trillions of dollars being poured into climate change and other similar industries, and the level of legislation and political changes being made. For example, the plastics packaging tax. You'll be aware that in a few years from now there will be no more petrol or diesel cars manufactured. They want it all electric. The technology hasn't caught up for that level of demand that policymakers are creating. So there is a huge amount of investment going into various technology sectors in this particular area. So for us, it's a very, very interesting area, and it's a very high growth investment theme. So in terms of where are we targeting investment returns at the moment, we're taking advantage of current market discounts. So, there are quite a few markets and sectors which are trading at big discounts compared to where they were a year ago. So there are value-driven opportunities there in terms of increase in share price over time, especially as dividend payments start coming through as well. We've got the whole climate change agenda. There is a whole issue around energy, and whether we like it or not, fossil fuels are a natural resource which are scarce, and the globe is, the world is moving towards cleaner energy resources, and again, that's something which has to be invested into, and there is a huge amount of money to be made in there. Obviously, areas around healthcare are constantly seeing innovation through. Obviously, there are some very good opportunities in pharmaceuticals at the moment with COVID, etc. Overall, R&D tech spending in the UK is now increasing to £22 billion a year, and that's just the UK. So again, considerable focus in technology and innovation. And we're now taking a shift away from cyclical sectors and consumer-driven sectors and moving into other areas. That then leads me on to my last point, which is impact investment. Now, this is a term that you may have heard of, and you may have heard of terms like socially responsible investing or ethical, environmental, social and governance investing and so forth. It has become a very, very big bandwagon. And if you do any reading in the financial press, you can Google social investments, and you can come up with all sorts of funds that have these components within them. Our view is please do not try and do this yourself, because it is a massive, massive bandwagon, and there are so many pitfalls and lacks of governance within the way that the way that these funds are managed. So if you want to get into these sectors, and in particular, our belief is to do it in the right way, ethically, morally, and financially from a risk perspective. The best way of doing it is through something called impact investment. Now, Fairstone, because we have such strength in the marketplace, we recognized that impact investment was something that was going to be very, very important as an investment theme for our clients. So we went to the UK's only specialist impact investment manager called Tribe, and we put together a range of specialist discretionary portfolios. Now, you can only access Tribe's portfolios normally as an individual if you have over £1 million to invest. But through Fairstone, we have created a dedicated set of risk managed portfolios. So anywhere from 3 to 7 out of 10 on the risk profile, you can now get into impact investment. And it's done it in a properly, fully diversified manner. And the results speak for themselves. So the principle behind impact investment is we're making good money, but doing good for the world around us. So you can see there in the bottom right-hand corner, some of the areas that we're looking at here, but basically any areas around technology, healthcare, zero hunger, education, innovation, climate change, the blue economy, economic growth, and so forth. There's 17 of these areas, which are basically the United Nations has defined them as sustainable development goals. And these are basically the areas where we're seeing the highest growth. So as I say, it doesn't really matter whether you're ethically or morally interested in these. It is just a huge, huge growth area. And these portfolios have proven not to be just highly resilient in the coronavirus recent issues, but they have, even over the last 12 months, year on year, massively outperformed the markets. So you can see there, looking at the outperformance based on their benchmarks. So comparing to other relevant portfolios in the same sectors, they have outperformed by anywhere from 3.5 to 11.3% in the last 12 months. So for example, if you were in the 5 out of 10 portfolio straight down the middle, you would have made over 12% in the last 12 months. It's phenomenal. Now, I don't, that growth level was very good. I think it will still continue. You won't make 12% every year for the rest of your life, but they are still outperforming very, very well. And this is, for us, it's a very, very key part of our clients' portfolios now going forward, because it provides a huge level of diversification into other areas that traditional portfolios don't give access to. I hope that was all very helpful to you. I've gone through things very, very quickly. I hope it's been useful, and I'll open up for questions.
Well, thank you, Ajay. Ajay, you just rushed through inheritance tax planning.
Yeah.
If we allow you a few more minutes, do you want to give us the bullet points of inheritance tax planning for pensioners like me?
Okay, so the key thing with inheritance tax planning is that there is a tax of 40% when you die, and that's 40% on your total estate based on, the first rule is that every person has what's called a nil rate band, NRB. So that nil rate band is £325,000. So let's say you have a husband and wife, and in your will, this is really key that you write the right things in your will. So get a good will writer. And in your will, it has to say that, let's say, for example, typically speaking, you say, okay, if I die first as the husband, everything is then going to go to my wife. And then when my wife passes away, everything is then distributed between my children in whatever percentage. What that then allows you to do is to benefit from two amounts of nil rate band. So 325 and 325 twice makes 650. So therefore, the excess or the amount before any inheritance tax bill is payable is 650,000. What then happened is that the government then brought in something called the residence nil rate band. So if you have a property, a residential, your main residence, and as long as you are leaving that main residence as part of your will to your next of kin, then you will then benefit from a residence nil rate band on top of that, which will give you another £375,000 on top. So effectively, you've got £1 million of nil rate band before any inheritance tax is payable. Now, some of you, the key thing to remember though is if you have written your will a few years ago, some terms that so some of you may recognize things like splitting the tenancy and doing a discretionary will trust. If those terms are familiar to you, then just check your will very carefully, because if you made your will a few years before the residence nil rate band came out, because the residence nil rate band has only been out for 4 years now, or 3 years, sorry. So if you made your will before then just check that, because some wills and the way that the residence nil rate band and the discretionary will trust interact actually exclude you taking advantage of the residence nil rate band. So your wills do need to be checked and reviewed, and we always recommend we review your wills regularly anyway. But what I often come across as well is people tend to think, okay, well, you know, everyone is probably aware of the 7-year rule, to say, okay, well, if I give my money away, as long as I survive for 7 years, then it's okay. There's no inheritance tax payable on that money. That's very true. There is always a risk as you get to the later years in life. Well, am I going to survive 7 years? Because that's not up to us, it's up to the man upstairs. But secondly, we don't always advocate that you just gift money away just unconditionally, because once the money is out of your hands and it's in your children's hands or wherever, you have no control over that money. Now, that's absolutely fine. That's a personal choice, but we've come across too often issues where, you know, families can, your children, their relationships can break down. There could be divorces. There could be, you know, all sorts going on. And all of a sudden, that hard-earned money that you wanted to go for a specific purpose is no longer there. The other issue we do see is that families do tend to play very nicely together until the main person has passed away, and then all sorts of people come out of the woodwork. I'm not trying to paint a horrible picture for the sake of it. The point I'm making is that there are always, in every family, there are so many implications that need to be thought through. And quite often you can incorporate trusts and various other forms of very tax efficient planning where you can gift money outside of your estate, do it in a very tax efficient manner, save inheritance tax, but also benefit from retaining control of the money. So in the worst case scenario, you need to pull that money back or some other issues take place in the future, you can, you know, you've got control.
Excellent. Well, thank you, Ajay. I think we have about 42 participants, but don't be despondent. Your talk is going to be circulated to 400 to 500 members, and also we will put it in the YouTube. All right. So you've done very well this morning.
If it's okay, I'm gonna pass on to Naren.
Yeah, yeah. Just very brief, because we already gone beyond time. Yeah, thank you.
Dear all friends, I call you all friends, of course. We are all similar age, it seems like. You know, I'm heading towards 68 in December. So I have been in business for 45 years, long time. So I feel as friends, we all know each other. We have come through a life at our stage of life. So I feel connected. Jay, without your support and help, we wouldn't be doing this today. So very grateful to you, and thank you for introducing us to your wonderful friend, Raj. I have had many discussions with Raj over the last 6-7 months. So I feel I have become your brother, which is absolutely brother. So it's very, very good. What I want to share with you.
You're going to transfer some wealth to me then.
What I want to share with you is that we, over the years, we become fussy in the way we do things, just like you are fussy in the way you advise your client. We are equally the same. So we become very possessive about the way we look after you, your affairs, your money, your finance, your family, your children, their children, and tax and so on. So our head is about capital preservation. We appreciate what it takes to create whatever monies and wealth you may have created. We appreciate that because I've done the same over the last 40 odd years. So I know what it takes. So every pound matters. So when we come to you, we are possessive and we don't want you to lose money. So whatever your ideas you may have, and you may say, well, I like to buy a property. So first question is, what's the risk that goes with it? And is that a good idea for you specifically? Not anybody else. It may be a good idea for the world, but is it a good idea for you, for your age, for your health, for your financial, the way it's structured and so on? So we don't like you to take a risk that's going to come to haunt you. Because whatever you invest in, whether it's property or whatever it is, you're trying to make money. So the bottom line is you want to make money. My passion is to do nothing but to make money for you. Because unless I make money for you, we don't make nothing ourselves. So it is about self-preservation here for all of us. So how do I make you money? And that's the first question. So whenever we get together and we talk to you individually, we say, let's see your current situation, what you're doing and this and that. And then how do we take you to the next level up? And we come up with a specific plan, structure, tailor-made to suit your circumstances. There is no one answer, never is. Jay and I have been going back 25 years, and we've done a lot of things together in the past. And Jay will share with you in his own time that apart from financial planning and wealth and pension and so on, there are many other things we end up doing together and advising and so on. So we become your family member. So look at me as your brother, and look at Ajay as your son. And as your son, he will do the best that the son would do for his parents. Of course he would. And he's got all the culture and everything else that goes with it. You'll find him a person of tremendous human values as well as professional to the T in what he does. He's not brilliant than I am because he understands all the technology and all the latest bits and pieces. My brain doesn't take much in it nowadays, whereas he's very sharp. So even I have to refer to him from time to time and say, what about this, Ajay? And of course he has the answers. So we are very fortunate. You have a father and son here to serve you guys. We are your servant. We serve you and put you in the best possible position. We are exceptionally proud in the way we do things. Our reputation matters to us, and we maintain that over the years, and we'll do the same for you. I think we'll thoroughly enjoy the relationship, and something will come. So connect with us, connect with both of us, and share with us where you are. And our specialty is we'll tell you what we believe is best for you. A lot of time you have in your mind, you know, what do I do? Shall I do this? Shall I do this? Shall I do that? Options that you have in your mind, and you don't know who to talk to. Because whoever you talk to, they'll give you all different things, and you're now more confused. Well, that confusion gets killed when you speak to me. And I will give you exactly what I believe you should do, and I'll take away all the options, all the confusions, and I will protect you, and I will say to you, brother, for you, this is what you do. That's it. That's why people with 100 million come to see me. So that's what we do, my friends. Whatever you have, whether you have 10,000 or 10 million, it doesn't matter. It's not about money. It's who you are. We love you individually as you are. And that's what this is about. It's connecting with you. Raj, thank you for giving us opportunities to connect with you, your friends, and your colleagues. Thank you.
Thank you. Thank you.
Thanks, Simon.
Thank you, Naren Boy, for that final touch, which is very touching. Thank you. I close the meeting with this. Okay, thank you. Goodbye.
Goodbye. Thank you.